President Trump abruptly announced a 2-week suspension of strikes on Iran. This triggered an immediate unwinding of geopolitical risk. Traders rushed to cover downside bets, sending the VIX plummeting straight toward 20. Looking at this daily performance scoreboard, the tech-heavy Nasdaq squeezed out a 0.1% gain, pulling the S&P up 0.08%, while the Dow slipped slightly into the red. That drag on the Dow comes directly from a 5% sell-off in the energy sector, driven by crude oil prices plunging back down to $94 a barrel on the ceasefire news. Traders are refusing to push equity prices much higher. They want physical confirmation that shipping traffic has permanently resumed in the Strait of Hormuz before committing fresh capital. In the bond market, Treasury yields dove in early action. The 10-year dropped a full 10 basis points to settle near 4.33%. The Federal Reserve is not matching that geopolitical relief. Chairman Powell maintains a firm hawkish pause. This line chart traces the recent spike in ISM services data, hitting 54%. That means prices paid by service providers are at their highest levels since 2022. Adding the services PPI component to the chart reveals the largest one-month increase in 13 years. Supply chain shocks eventually resolve, but this sticky services inflation is the actual threat to the equity baseline. It keeps a late 2026 rate hike firmly on the table. The market dodged a 10% correction last week. We are now executing an aggressive V-shaped bounce, defined as the red line recovery. Look at this technical stock chart. The S&P 500 successfully tested major support floors and has confidently broken back above its 200-day moving average of 6,655. Capital aggressively rotated into growth. Technology and semiconductor sectors jumped roughly 5% on expectations of normalizing global supply chains. That capital drained out of energy laggards. Exxon and Chevron both took 5% haircuts as the geopolitical war premium vanished from crude. Looking at individual momentum, Micron surged 9%, cruise lines jumped over 8% on the prospect of cheaper fuel, and Apple rose 2%, shrugging off rumors of iPhone production delays. With forward price-to-earnings multiples compressing from 21.7 down to 19.7, the focus is shifting. The market is pivoting from geopolitical survival directly to earnings achievability heading into Monday's Q1 reports. That valuation compression sets the stage for our quantitative value analysis. We apply a 25% margin of safety to identify actionable targets across 4 major indices. This matrix table isolates 20 targets. 8 actively flag inside the buy zone: Estée Lauder, PayPal, Keurig Dr Pepper, Verizon, Walgreens, MGIC, Adient, and Tidewater. We monitor the remaining 12 targets, tracking names like Cisco, Apple, and Chevron until they hit calculated floors. This week's extreme volatility burned off a layer of market froth, leaving a window to acquire these specific, beaten-down quality names before earnings season dictates the momentum. The data holds immediate real-world weight. The $11.34 per barrel plunge in oil prices forces a hard reset on operational budgets for engineers managing offshore assets in Gabon. Meanwhile, the drop in the 10-year Treasury yield offers a brief but critical window of stability for property investors in Singapore looking to lock in SORA-pegged mortgage rates. The volatility isn't over. This is a show-me market. Prioritize return on equity and free cash flow over speculative growth, and keep your powder dry until the global oil baseline stabilizes between $80 and $90.